Picking up where we left off. Didn't really get like a nap, but I was able to lay down. I feel better. So, all right, job order costing.
In this segment, we will discuss a job order costing system. Companies that manufacture products need to account for the costs of production, and there's two different costing systems that enable them to do that. The first is a job order costing system. This system is used for production of large, unique, or high-cost items, such as cars, boats, or special order items. These type of products are built to order rather than being mass-produced. They incur many costs that can be directly traced to each job. The other type of costing system is a process costing system. This is used for companies that make large quantities of homogeneous products that are difficult to distinguish from one another. A process costing system will be discussed at a later time. Manufactured products need to account. Companies that manufacture products need to account for the cost of production, and there's two different costing systems that enable them to do that. The first is a job order costing system. This system is used for production of large, unique, or high-cost items, such as cars, boats, or special order items. These type of products are built to order rather than being mass-produced. They incur many costs that can be directly traced to each job. The other type of costing system is a process costing system. This is used for companies that make large quantities of homogeneous products that are difficult to distinguish from one another. A process costing system will be discussed at a later time. We can see the flow of costs through a job order costing system. Recall that there are three costs companies incur when producing a product. They have material costs, they have labor costs, and they have indirect costs, which we classify as factory overhead. Material costs in a job order production system. Direct materials. Direct material costs are recorded right into the goods and process inventory account as they are incurred on the units produced. Indirect material costs, the actual indirect material.
Oh, from where? Shit. Oh, there you
Hello, everybody.
go. Oh, fuck, I went where? Oh shit, I opened chapter 19. Damn. Okay. Do chapter 18 first. Damn, bro. All right. I didn't realize that. I was not paying attention. All right. So I had all chapter 18 stuff except for one one little tab, and apparently that's the one I was on. So damn, son. Cool. Here, let's go back. All right, chapter 18. Let's do this the right way, chronological order. I'm sure they're set up that way for a reason. Chapter 18, checklist and learning objectives, introduction. This module, did I read this? Okay, yeah, I did that. Okay, so don't need that. Good there. Mini lecture videos. Okay. Now I have to edit the description here. God damn. Type this too. that. You gotta do it.
Hello. In this episode, we're going to discuss the differences between managerial and financial accounting. Managerial accounting provides financial and non-financial information to organizations, managers, and other internal decision makers, whereas financial accounting provides general purpose financial information to those who are outside of the organization. The users and decision makers of financial accounting are investors, creditors, and other external users, whereas managerial accounting information is used by managers, employees, and other internal users. The purpose of information in financial accounting is for users to make investment, credit, and other decisions, whereas managerial accounting, the purpose of information is for planning and control decisions. Flexibility of practice. Financial accounting is often structured and controlled by generally accepted accounting principles, whereas managerial accounting is relatively flexible. Generally accepted accounting principles do not put constraints on how information is reported. Timeliness of information. Financial accounting is often available only after an audit is complete. However, managerial accounting information can be provided quickly without needing to wait for an audit. Financial accounting information is historical information with some predictions, but typically mostly reporting on what has happened in the past. Whereas managerial accounting takes the financial information and projects and provides estimates into the future. The focus of information. Financial accounting's emphasis is on providing information for the organization taken as a whole, whereas managerial accounting can provide financial information and break it down into projects, processes, or segments of an organization. Finally, financial accounting is almost always reported in terms of monetary information. However, managerial accounting is provided in monetary, but often in non-monetary information as well. Hello. In this episode, we are going to discuss managerial cost classification concepts. An organization's costs can be classified in different ways, depending on how information is needed by managers to make managerial decisions. We can classify costs by their behavior, by their traceability, by their controllability, by their relevance, and by their functions. Cost behavior refers to a cost reaction to changes in the level of business activity. A fixed cost does not change with changes in the volume of activity. Rent expense. The amount of rent expense does not change as production levels increase or decrease. A variable cost changes in proportion to changes in the volume of activity. Material costs increase or decrease as the level of production goes up and down. A mixed cost refers to a cost with a combination of both fixed and variable elements. Utilities. Utility expense is a combination of a fixed amount for service of utilities, as well as utility usage costs. Organizations cost by traceability, we're looking at them by whether they are direct costs, costs that we can trace directly to a single cost object, material and labor costs for a product, or we can look at indirect costs. These are costs that an organization incurs that we cannot trace directly to a single cost object. For example, maintenance expenditures that benefit departments. Maintenance expenditures cannot be traced directly to one department. It is indirectly traced. We can classify costs by controllability. The degree of control depends on the level of management in the organization. Managers at higher levels in the organization have a greater degree of control over costs than do managers at lower levels. Classifying costs by how they are controlled is an important part of assigning costs, assigning responsibilities, and evaluating a manager's cost control performance. If we look at costs by their relevancy, sunk costs are all costs that are incurred in the past and they cannot be avoided or changed in the future. In making managerial decisions, sunk costs should be ignored. For example, a machine that was purchased 2 years ago at a cost of $15,000. That $15,000 purchase price is sunk because whether or not that machine is kept or replaced, that $15,000 cost cannot be changed. Relevancy and out-of-pocket costs. Costs that require a future outlay of cash. Out-of-pocket costs should be considered in managerial decisions. For example, if manager is planning on buying a new machine for $25,000, the cost of the new machine is a future out-of-pocket cost, and it's relevant to the decision of replacing the machine or not. When we also consider relevancy, we have to keep in mind opportunity costs. Opportunity costs are the potential benefit lost by choosing a specific action from a couple of alternatives. Opportunity costs are always relevant in managerial decisions. If a company decides to produce a new product and gives up sales of $20,000 per year on an existing product in order to do so, the opportunity cost of producing the new product for 1 year is $20,000. It is very relevant to the decision about whether to produce a new product or not. Finally, we can classify costs by their function. Product costs. Product costs are costs incurred to produce a product. The direct materials, the direct labor, and what we call manufacturing overhead, or the indirect cost of producing a product. Let's look at the different accounting treatment for product and period cost. Recall that when a manufacturing company is producing products, it is incurring two different types of costs. It is incurring period costs, or costs that have nothing to do with manufacturing the product, and it is incurring the production costs, or the manufacturing costs to produce. For all of the product costs, the inventory that is produced will either be sold in the current period or sold in a future period. All of the costs incurred on inventory that is not sold must remain as part of an inventory asset account. Those three inventory accounts that are used to account for the cost of production are the raw materials inventory, goods in process inventory, and finished goods inventory account. These three accounts accumulate all production costs of inventory as it is produced. Those costs will either be sold as part of cost of goods sold and recorded as an expense in that year, or those costs will be attached to inventory that is sold in a future period. And only when that inventory is sold in a future period will it become cost of goods sold. Please note that all of the non-manufacturing costs that a company incurs, those manufacturing costs are recorded as an expense in the period that they are incurred. So what we're seeing here is that product costs, all costs incurred to produce a product, are recorded as an asset, as an inventory. And those costs stay in inventory until the inventory is sold. Only when the inventory is sold do the cost of producing become cost of goods sold. All non-production costs become an expense in the period that they are incurred. The accounts that I mentioned are the raw materials inventory account. This account accumulates the cost of direct or indirect materials that are purchased waiting to be used in the production process. As inventory is begun in the production process, the goods in process inventory account is used to account for the cost of inventory incurred as it is being manufactured. Inventory is the completed and ready for sale is recorded in the finished goods inventory account. This inventory account keeps track and traces all costs of completed inventory that is ready for sale. You can see that the major difference in accounting for inventory between a manufacturer and a merchandiser or a retailer is how the inventory is acquired. In a merchandiser, beginning inventory is added to the amount of inventory purchased. If we subtract out the amount of ending inventory, it gives us the amount of inventory that is sold. Whereas in a manufacturer, the beginning finished goods inventory is added to the cost of the inventory that is manufactured. If we subtract out the ending finished goods inventory, the remainder will be the cost of goods sold. Looking at the income statement of a manufacturer, cost of goods sold differs only slightly from the cost of goods sold for merchandisers. In a merchandising company, purchases; in a manufacturing company, cost of goods manufactured account for the cost of the inventory acquired. But that is the only difference in calculating the cost of goods sold between a manufacturer and a merchandiser.
Chapter 18, good.
Managerial Accounting Basics. C1.
Again. Come on.
Managerial Accounting Basics. C1. Explain the rules and ethics of managerial accounting. Managerial accounting provides financial and non-financial information to an organization's managers. Managers control or direct a company or one of its many parts. Examples are an employee in charge of a company division, the head of marketing, the information technology officer, the human resources head, and top-level managers such as the chief executive officer, CEO, and chief financial officer, CFO. This section explains the purpose of managerial accounting, also called management accounting, and compares it with financial accounting. Purpose of managerial accounting. Managerial accounting provides useful information to aid in determining the costs of an organization's products and services, planning future activities, comparing actual results to planned results. For example, managerial accounting helps marketing managers decide whether to advertise on social media such as Instagram. Managerial accounting also helps Google's information technology manager decide whether to buy new computers. The managerial accounting system collects cost information and assigns it to an organization's products and services. Costs are important to managers because they impact the financial position and profitability of a business. Costs are also important for decisions such as product pricing, profitability analysis, and whether to make or buy a product. Much of managerial accounting involves gathering information for planning and control. Planning is the process of setting goals and making plans to achieve them. Companies make long-term strategic plans that usually span 5 to 10 years. Strategic plans are then turned into short-term action plans, which are more concrete with better defined goals. A short-term action plan that includes dollar amounts is called a budget. Control is the process of monitoring and evaluating an organization's activities and employees. Feedback from the control function helps managers compare actual results with planned results and take corrective actions. Exhibit 18.1 shows the relation between planning and control and the types of questions managerial accounting helps answer. Page 652. Nature of managerial accounting. Exhibit 18.2 highlights key differences between managerial accounting and financial accounting. Exhibit 18.2 Managerial Accounting versus Financial Accounting. Financial Accounting, Managerial Accounting. Users of accounting information. Companies report to different groups of decision makers. Financial accounting information is provided primarily to external users, including investors, creditors, and regulators. Managerial accounting information is provided primarily to internal managerial and executive employees who are in charge of a company's business activities. Purpose of information. External users of financial accounting information often decide whether to invest in or lend to a company. Internal decision makers use managerial accounting information to understand, analyze, plan, and control company activities. Flexibility of reporting. Financial accounting follows concepts and rules known as Generally Accepted Accounting Principles, GAAP, to provide consistency and comparability of financial statements across companies. Managerial accounting provides internal information and is more flexible, not rules-based, reflecting the needs of managers to analyze, plan, and control products and processes. Timeliness of information. Financial accounting.
I feel like it's a little bit boring because I'm listening today. Okay, all right. Be right there. All right. Back. Timeliness of information. Financial accounting provides information to external users following required time periods, such as annual and quarterly. Many financial statements are delayed until an audit is done. Managerial accounting provides information to internal users as they request it, and this can be as immediate and frequent as demanded. All right, gotta take a little bit of pause. Close enough that 30 minutes, gonna go longer on the next one, so we'll do another what do you call it, office hour session in a little bit. So BRB.